Good afternoon. I know it's the last lecture. Most of you are like, if it was before lunch, my normal line is, there's a very thin line between hunger and anger. I think that the same applies, except that most of you guys don't want to be here, want to get out of here, even if you're not going back more into the city. Anyway, so when I was asked to talk on finance, let me just quickly give you why I even try to talk about this. Because though I teach finance and I am a faculty in the area of finance at IIM Bangalore for the last 17 years now, 17 plus years, I do not know finance. And I'm being honest, and I still today walk into a class and ask people, and I ask anybody, I can safely ask out because I can more or less safely assume that none of you are accountants, right? I ask any accountant friend of mine that explain to me a simple story. When my bank passbook, which is a single entry balance sheet, works fine for me, and fine for all of us, why do you have to make life so complicated and make a double entry balance sheet? That's my understanding of finance. The only way I got, by training I'm a statistician, the reason I got into finance, and that's pretty much most of what I do and what I'm going to try to talk about for the next hour or so, is that what we figured out what people figured out, not we, I mean obviously I just picked up the threads and tried to follow somewhere down the line. What people figured out at some point in time is that most systems or most processes in finance could easily be defined in terms of existing mathematical processes. Various different mathematical processes, yes, under certain constraints and certain boundary conditions as we would want to put it. As quant people, you would say, okay, I did certain boundary conditions, certain different stories. So to give you a simple example to start with, which is not actually time series, but just to give you an understanding of what I'm talking about, you see, you have an equation, some kind of a complex equation, and not complex in the sense, but it's complex in terms of complexity, and an outcome of that is a negative outcome. That's a perfectly valid mathematical outcome, right? Why does it necessarily have to be, why does every equation need to result in a positive solution? No problems with that. If you look at, for example, one of the most common things to look at is, let's say, interest rate evolution over time. How does bank interest rates or interest rates in the country evolve over time? And therefore, if you were to try and do some predictive modeling on that, after all, knowing today's interest rate doesn't matter to me because that's known by everybody in the market. The benefit is if I can create a model by which I can predict what will be interest rate 6 months down the line, like anything else. If you look at it, the equation is nothing but what in physics people have talked about for years as what is called as the Bessel equation. It's basically a pressure modeling equation called the Bessel equation with a certain gamma. The only constraint now is, when you apply into interest rate model scenario, gamma has to take a certain set of values, because otherwise the equation turns out to give you negative solutions, which obviously doesn't make sense in the context of interest rates. But if I can control for those factors, or if I can manage those factors, then essentially I'm not creating anything new. I'm actually using the existing literature, used somewhere else, but applying it into a context and saying, okay, this kind of defines a financial system or a financial outcome. The other classic example is, which is something which, okay, not so much in time series, but in the stochastic Markovian world, which is used extensively in finance, is this whole story of Ito calculus. Ito's lemma and Ito calculus. And if you go back to Ito calculus in 1952, nobody knew about that in finance. Ito's lemma, when it was developed, when he published it and it was developed, was pretty much purely for mathematical process. And in simple terms, it was what? It was to kind of ensure that if you had a random process, how do I represent a random process as a function of or how do I represent a stochastic integral as a function of a time integral and a time-dependent process? And you go, and then there's a whole model and a whole approach that he proved that this is what you can do. What people figured out later, at least in the Markov, if you use the Markovian approach in finance, or believe in that part, and just come back to that in a minute, that's an application that can be done, which can then be used to price a host of products in finance. So in that sense, there is really no major quant theory that has been developed in finance. It has been developed elsewhere. It is applied elsewhere. It is just that it is modified, I won't even say modified, but suitably adjusted and controlled for to use it in finance. Which is why people like us who have zero understanding of finance, as I said, can still survive in this environment. Because as long as you can add 2 and 2 and not get a 5, we can survive. Okay, so the primary argument out here predominantly has been, though it's maths, but predominantly it's in the stats part which has been used primarily. things like theories like probability and all of that have been the primary drivers that have been kind of used in applications. Okay, just before I talk about good, so actually when I was asked to talk, I really didn't know what I would talk in about an hour. So what I've done is, and this is what I was telling Professor Apte also, I have got a first few slides on a very generic framework. And then I have a few slides on work that have happened, I mean primarily work that I have done, which have applied some kind of time series approaches to show you how you can kind of use it in different contexts, snippets of that, and then we can have any discussion that you would want to have, right? So the primary model has been essentially usage of statistics and statistical techniques. Probability theory has been one of the primary drivers. Because like anything, the fundamental problem is what is it going to be in the future? Right? Knowing the current, knowing the past is useful from an academic standpoint, but from a practical argument that is of zero value. If I told you the price, I mean, we know the price of a product today. I can even give you what the price of the product was for the last 10 years. Unless I can use that information to find out something about tomorrow, that information is actually useless. And the whole value is to find out something for tomorrow. Which means any kind of prediction, and that is where probability and all other predictive tools essentially come into picture. This has been used across the board over the years, but what has happened is in the last about 50 years or so now, the application area of finance has also been added on. Statistics has been used in various different application areas, nothing new about it. All of those surveys and all of that have been there for centuries. It's just that, in an organized manner, for the last 50 odd years, we've also seen a significant application scenario in terms of finance, which is obviously good for most of us in this room, because then, as academics, that also gives us another avenue to kind of work on or look at. Having said that, just as a small footnote, it is not necessary that this, though we say 50 years or so, it's not actually entirely true, because some parts of application of this, of probability, time series, and information was used as far back as about over 300 years back, when the first insurance premium was computed, or was asked to be computed by the Dutch government for an insurance scheme for its citizens way back in the early 1700s. So way back in the early 1700s, the Dutch government decided to kind of figure out a mechanism by which what would be the premium charged, a premium payable for insurance that they would offer to the citizens. Now obviously, one of the important things that you need to look at out there is again life expectancy. Life tables existed. The difference is out here. Life tables existed. People knew what historical mortalities were there. But as you went forward, how long would a person live would also be a determinant in terms of what would be the premium. And at what point you entered. So in some sense, it was like in a crude manner, it was kind of looking at Bayes' theorem. Conditioned on the fact that I am at a point X, with all the information available at that point X, how long would I survive? And this condition, while the conditioning argument would remain the same, but the conditioning information at omega would be different for every individual. Because age would be a factor, pre-existing conditions, and a lot of other things would kind of come in. So that essentially became an application story that came in. And actually it also involved a fair amount of time series arguments also in the crudest form. And where did it come in? Because after all, I had information about an individual. How would I form an opinion about that individual? So then they basically looked back and said, okay, based on life tables and other data, they said, okay, how many people like this were there and what have been their life expectancies? So today you are here, fair enough, but if you were there in a similar scenario 50 years back, with a similar information set, where would you have landed up? And use those in some more complicated manners to kind of find it out. That over the years, this discipline actually has spun off separately, and over the years, and today it's one of the most promising, most attractive disciplines to work on, both academically as well as professionally, non-academically as well, which is essentially the whole argument of actuaries. So the whole argument of actuarial studies essentially started off with that how do I look at all of these things, and then has kind of morphed into moved on into being a discipline by itself. Now, if you look at data per se and look at this argument, There are basically two ways in which, or two schools of thought, and I'm not saying one is better than the other. One is essentially the standard traditional time series argument, time series based model, which predominantly works on the rationale that there is a repetitive nature of data. As commonly put, history repeats itself. Obviously, the frequency at which repetition will happen is not known, and that's one of the challenges. But essentially, there is always this argument that history would repeat itself, and therefore, if I have historical data, I will be better placed to be able to adjust or to be able to predict what is happening in the future. Which is very standard story that is applied everywhere, which is why you always say, okay, get as much of data as possible, because the larger the data set that you have, the more amount of information you have captured, and therefore you are better placed. That's the primary time series argument. But there is one small deviation, I'll come to that in a minute, which is the last point. The other argument is, which has also gained a lot of ground, by the way, that's where predominantly I prefer that, but obviously we've also looked at the other side, is what we talk about is a stochastic process based, essentially a Markovian approach. Which by definition, as Markov process would be defined, as all of you would tell me, basically it's a memoryless property. There is no memory. Having said that there's no memory, that's not actually entirely true, because all it says is the current information is what is relevant for tomorrow and not the history of the information. So essentially, if I write down the conditional probability is only on today and not the history of the information. But if I write this down in a recursive manner, you realize what happens. If tomorrow is dependent on today was dependent on yesterday, and so on, so there is essentially some linkage. So what's the difference? The difference is, in a time series model, unless I explicitly argue or explicitly prove that certain information is irrelevant for the future, that would always continue to be accounted for. So if I take the last 5 years data, the information set will always be last 5 years, irrespective of the fact some things out there may not be applicable in the future. In a stochastic process model, a Markovian model, what would happen is only the relevant information would get carried forward, and therefore if there is something which is relevant, that would be there, else it would always be accounted for at the point in time it was relevant, but not necessarily carried on to a point where it is irrelevant. So I'll give you, just to give you an example of what is the difference I'm talking about. So for example, if you look at financial markets in India, for example, let's say you take dollar-rupee exchange rate, right, which is basically, what is the dollar value? Today the dollar value is somewhere, I'm not asking you the today dollar value is somewhere around 70, 69, 70, 71. And actually I can go back and, from a time series perspective, get daily dollar-rupee values all the way back till 15th August 1947, right? So the question is, if I ask you, let's do a prediction for what would be the dollar value, let's say, 1st of January next year, right? In a pure time series argument, we have as much of data, which means take all the data as possible to start with, and then you put whatever model to predict the future. The question now is all this information relevant? Because after all now you also look at parallelly along with it, what are the economic conditions under which the dollar value was whatever it was? And is that relevant going forward? So is it worthwhile for me to consider the dollar-rupee rate in the 1960s for a prediction in 2019, because as the economic conditions are the same? And I'm deliberately using this example because it's easy to identify out here, whereas in many other cases it will not be easy to identify. You take that, so if you use that, obviously then you say, no, all this is not relevant, I'll only use relevant data. One argument of relevant data is, let's look at the most recent information and not really a very old information. Fine. The next question then I'll ask you is, okay, fine, don't take the 70 or the 72 years of data. What point do you cut it? Let's say we agree we'll only use the last 5 years data. We'll use whatever, last 4 or 5 years. What point do we cut it? What point do we believe that the system does not have a structural break, and therefore that is relevant data? You can test for it. There are other ways to test for it, and there are structural break models and all that you can use, but on the face of it, it's not that straightforward to kind of do that. And that's a challenge that typically comes in the time series argument. Right. Whereas here, that will not be the problem. Because on the Markov process argument, it's obviously relevant information. Since the market always has all relevant information, so my history does not really matter. Having said that, while that would mean that time series is actually not a very good idea, it is not true, and that's what I wanted to say, which is the last one. What we also have, in some cases, is what is called as long memory. So in short, what it implies is, I don't see the impact of that today. So I don't see the impact of yesterday today. But maybe the event today, there is a long gestation period. Maybe something which has happened 6 months, 1 year back, did not impact in the short term, but has a much longer term and is kind of now impacting it. That can also happen, right? And again, the challenge in all of this is, what is this gestation period? How long does it take? And these are challenges that typically come in. And these are problems that exist. But that's all. But completely ignoring history may actually land up into a problem because there are certain information which comes in. By the way, when I say history repeats itself, I'm not saying the value coming back to itself. All I'm saying is if you drew a path, so the change, the process would repeat itself, not the values, obviously. Right? So maybe certain parts there are breakages, but there are parts in that. So identifying those historical values to kind of say what repeats itself is relevant and could be relevant, and that's the other application area that can kind of be looked at. Now there are a host of problems that you can kind of look at. If you look at it, these are some of the standard problems that you can kind of, I've just listed down a few of them, 10 of them, to kind of look at some of these problems that can be looked at from a time series perspective. While this is correct, but this can also be extended, and subsequently I think I have in the next slide, have an extension to that, or at least next to next slide I have an extension to that. See, for example, I'll go back to the other ones also, but if we look at the last one, what we are fundamentally saying is a correlation effect, right? And what is correlation? Essentially a short-term linear dependency between two historical data sets. Now, why does it have to be linear? Two data sets could be related, but does it necessarily have to be linear? And therefore, you can go back into this whole argument of nonlinear relationships, co-integration, and all of that can come in. I don't have it out here, I just wanted to add that to highlight that it doesn't have to be linear. Linear obviously makes life simple, correlation makes life simple. To that extent it's useful, but it does not have to be. You can look at, I've just put randomly a few of them, modeling long-term relationships between price and exchange rates. So it's because typically, if you look at a lot of these buys and all that are, not actually paying for tomorrow. You're getting into contracts where you will pay 6 months, 1 year later. Knowing today's dollar rate, we are reasonably certain what the value tomorrow will be. Not 100%, but reasonably certain what the value tomorrow will be. But to say what will be the value 6 months later is where the biggest challenge is. And doing a simple regression-based approach does not necessarily work because the linearity may not be there. The relationship is not linear at all. Right? And hence, you do need other kinds of things. So the long-term relationships are obviously have to be modeled separately, and that has to be accounted for. Volatility is the other argument that you kind of look at, because it's by definition it's a second order variable, right? It's a standard deviation. This variance argument. You're trying to forecast volatility. So essentially you're saying what would be the variation range that we're talking about, and you can talk about that. Interestingly, this is also fairly important in terms of how does credit ratings change by the rating agencies, and how can that be applicable? How is that applied in practice? So what is a credit rating? A credit rating is supposed to be. It may not actually happen because in practice we've seen enough problems around that. But a credit rating is supposed to be an independent verification of the ability of the borrower to repay. Right? The reason why it does not always happen in that, and before somebody tells me that is because in that there's a small caveat that they have. The rating is of the issuer and not the issuer. So it is in general, and when a bond rating happens, the issuer is not being rated. the rationale with which the money is being raised, that issue is being rated. So I could have 5 different issues running, so I could borrow money 5 different times or in 5 different ways. Each could have a different rating. The argument is that if I borrow money for a certain cause, I'm going to repay based on, what is the inflow from that factor, and I will repay from there. So therefore, if I could borrow one for a less risky project and one for a more risky project, and therefore each one is kind of rated independently. In theory, this is fine, but in practice, what happens is, after all, remember, money is fungible, which means money I get from here, I can easily use to pay it off somewhere else, and I can kind of play around with it. Which means that in practice, the rating of the issuer is also, at least, should be looked at. Right? And if you look at some of the failures that have happened, or some of the problems that we've seen over the last few years, essentially it has been exactly that, it's not that the rating of the individual processes were wrong, but the fact that the issuer was playing around with the system is where the crisis happened. Right? Now again, some of these things can essentially be looked at in terms of how do you identify and how do you kind of look at or try to predict that. Okay, now I just want to make 2 small points out here, which is, this whole argument about quantity and frequency of data and the quality, which also becomes relevant and suddenly has become, a big issue, at least in the last few years, last 8 to 10 years or so. This data was always there. It is just that we never had, we never had the ability earlier, given lack of resources, computational resources and all, to capture that amount of data. So if you look at the amount of data, market data is what is called as the tick data. Right? Which means every time there's a transaction, potentially every second or even smaller interval, there is a new data point. So in a day, the volume of data generated is enormous. We just can't think of it. Right? Is it something which has suddenly come up? The answer is no. It has always been there. The only problem is, or only thing is, that with advances in computing facilities, we now are in a position to capture that which we couldn't capture earlier. Right? So if you try to think of it, today if I tell you that, okay, let's do a trade, a buy or a sell, a trade in the stock market at 11:57:31 seconds, I will get a price exactly at 11:57:31. Right? 20 years back, when it was not, 25 years back, when we didn't have an electronic system in place, you would tell your broker in the morning that you do this trade for me at whatever during the day. The broker might still do it at that time, but what would happen is, you would get, if you are a buyer, the broker would always tell you, no, you know what, I bought it at the time when the price during the day was the highest. And if you were a seller, he or she always landed up selling at the lowest time point. So it's not that we didn't have the data, since the data was not captured, only the high-low was captured, that was all that came into picture. Today, with the increase in that amount of data has, and why do we have so much of data? And that's important out here, unlike most other scenarios, which is in financial market, there is really nothing called absolute data. All the price data that we have is nothing but a compromise point. It is the compromise value of the demand and supply information at that point in time. And every trade changes that information equilibrium, and hence there's a new data point. You see, if you think of it, if there's a fixed price, for example, if you buy this laptop or something, how do you price it? In a very naive way, you would price it by saying, what is this production cost? What are the taxes or whatever you have to pay? What is your profit? What are your costs for display and all that? These are all fixed costs. You add them. That's the price at which you will sell. Right? And therefore, whether you go to buy it, I go to buy it, you buy it in the morning, I buy it in the evening, I buy it a week later. If none of these factors have changed, the price on the product does not change. Now, if you think of it, when you buy it in the market, it's like I go at this point, and this happens in any market if you think of it. Even if you want to go and buy vegetables, you will find the same thing. You go, there's an excess supply in the morning, you can get it cheaper, potentially. You go later in the day when there's hardly anybody who has the stock and you still need it, the person can potentially price it at any point you like, and if you desperately need it, you will buy it at that price. And here it will not happen because the product out here does not expire. But if the product expired, you could actually explain that even further by saying, if you risked it and went really late, you risk the possibility of not getting the product. But if you did get the product, given the product will go bad, you might even get it at a cheaper price. Because for the producer, there's no question of taking it back because it's complete loss. So whatever I earn, actually airline pricing is exactly that. If you look at the airline pricing today, because today we've moved away from the fixed price airline model, right? You get different prices. If you buy, why do we say buy very early? So earlier you buy, you get a cheaper price. That's because there's a lot of supply. They want to fill it up, and it also works with another argument, which is the airline or an aircraft. Typically, if you have a load factor of anywhere around 45% or lower, it is actually not economical for it to fly. Interestingly, if the load factor goes up above 85%, again 85 or 90%, it is not economical to fly again. Right? So in the lower end, you want to price it low so that you actually go up to a level where it is stable. At the higher end, you actually want to price it way out. You don't actually want those people in the flight, the last 10%, because that is uneconomical for you. So essentially you're pricing it out, and you're pricing it so high that if somebody is still desperate to go, I'll give you a ticket, but I'm also offsetting along in the ticket the cost of flying, which otherwise would be uneconomical for me. Otherwise, think of it, why does a ticket, which if you buy 3 months back costs you, let's say 5,000 rupees, you buy it at the airport and fly in 3 hours, costs you 30,000 rupees. What's the rationale? Right? And again, if the airline doesn't sell the ticket, realize, on the upper end, it can afford to do that. On the lower end, if the airline doesn't sell the ticket and it still has to fly, there's no point. So essentially, it will kind of have lower prices and ensure that they at least get the economies of scale. And you can extend that to a lot of other examples like, hotel rooms, any kind of factors which would expire in that whole story. So, therefore, there are multiple prices. So there's one value that comes in, and what this also leads to is that there's a huge amount of data that we have that we can look at, which also gives us the advantage of looking at other things in that. Earlier we got 1 data point or 2 data points in a day. Today we have a few million data points during the day. So obviously our ability to model that data, splice and dice it in various different ways, is very high. Right. The other obvious question is quality. Now, in its true form, data is pure, there is no problem. But practically we always land up with fairly impure data. And that's because our recording systems result in having noise in it. And the effort is essentially to try to filter out the noise through various different means, because what we want is as clear a data as possible. It's that same thing, in time series, as we look at it, as we say, if you write down the equation, the last term is an irregular term or a random term. Yes, you have true trend, cyclicality, seasonality, and an irregular term. Now all the processes, all the time series processes are supposed to take out cyclicality, which we know how we can do that, seasonality, right? You do, for example, if you do moving average, you can do it for cyclicality, seasonality that you can take out. What you cannot take out, because that's the constraint that we have on our processes, is the irregularity. So what we'll end up having is like the true trend plus irregularity in there. We cannot really distinguish between the two. Right? We hope to kind of clean up the data by saying, okay, if there's a cyclical effect, let's take out the cyclical effect. If there's a seasonal effect, let's take out the seasonal effect, because that is what is going to get us the true trend. And that's what we kind of look at. So these are measurement errors that are I won't even say errors, but these are problems that we have with the measurement that we have, and that's the data that we have. So a lot of effort is essentially towards trying to take that out so that we get relatively clean data in the process. Some of the main techniques that we kind of use are obviously these. The relatively newer ones is essentially this one's ARDL, which is about now, I think the first paper came out in about, Pesaren was about 2001 or 2002, so just, relative to some of the other things, it is very, very recent. Relative to regression, which has been there for so long, a 2001 paper is pretty much yesterday's paper. I was only talking about co-integration. Arch-Garch is also, now very standard, but again, historically not very old, because the first Arch paper, I think Engel's Arch paper is 82, and Boleslev's extension to the Garch paper is 86 or so. So it's really not very old in that context. But kind of approaches that are used fairly extensively towards looking at changes that we modeling stuff that we can look at. Why did it go here? To just give you a quick thing, and before we move into some of the other work, some of the works that I wanted to highlight. You see, one of the basic assumptions in regression, in basic regression, is on the error distribution, right? And as to what is the assumption? In a standard regression, what's the basic assumption on an error distribution? Normal, zero mean, but zero mean is not really relevant because you can always scale it up or down, and constant variance, right? The whole argument of homoscedasticity, constant variance is the key thing. The mean is not really that important because after all it's only a location parameter shift, so even if you have a mean, you can subtract the mean and you'll always get a zero mean, so that's really not a challenge. But the argument is but the variance is constant. Now if I were to apply it in finance, what does it mean? Think of it, and that's where it does not, people started looking at other things and that's how other stuff got developed. You're essentially saying, so for example, if I look at market volatility, stock market volatility, what is stock market volatility? It is basically a measure of how much the market or the price of a product or the market itself will move in a certain period of time. It could be a daily volatility, weekly volatility, monthly volatility, whatever we take, right? How much can it move by? I'm not saying it will move to that value. So essentially I'm creating a band by saying it will move in this band, which is fine. Now if I say the volatility is constant, which means the amount it can move today, percentage, will be the same that it can move tomorrow and day after, right? Now that's a problem because you think of it, if it has moved, but in practice, conditioned on the fact that it has moved up today, why should tomorrow's move be independent of that information and be what it was at the starting point? If you take a constant volatility model, the problem that is, today I have a volatility for, let's say I do daily volatilities. So today I have a volatility for tomorrow, right? When I go to tomorrow, I actually now know whether the price has moved up or moved down and by how much it has moved up or moved down from yesterday, right? Now if I take a constant volatility model, then I'm actually ignoring this information that there has been a price move and of a certain magnitude. And therefore I'm actually and that could be relevant, that could be important and relevant. So a constant volatility model would actually fail, which is where the argument of a heteroscedastic model came into picture, which is essentially instead of taking a constant volatility sigma square, take sigma t square. So essentially the volatility is a function of the time at which you are measuring it. Now how do you now go and solve the volatility, solve that argument? Because after all I've now got to predict sigma t going forward. That's where the Garch model essentially came into, is a huge application. Arch is also there, but one can easily show that a Garch 1-1 model is an equivalent to an Arch infinity model, and therefore there's no point looking at an infinite model, look at the Garch model. Because of the error, the Arch is only on the residual lags, only on the lag on the variable itself. The Garch also includes the error of the residual lags, square of the residual lags. So essentially that helps us in kind of arguing, showing that an Arch infinity process can be modeled easily as a Garch 1-1 process, and we'd always want to model a finite process as opposed to an infinite argument, right? Univariate and multivariate modeling has also been fairly important because, which also links up to in the simplest form correlation or otherwise into co-integration, and as I said into Airedale autoregressive distributed lags kind of story. The argument is that why does it have to be linearly related? If it is univariate, if you can assume univariate is the starting point, if you can assume univariate distributions, life is simple. But why does it have to be univariate? It could be anything. There could be multivariate factors. Again, incidentally and interestingly, while we talk about multivariate modeling out here, this has been used in various other applications in maths, in quant, in engineering also. This whole argument, I don't know how many of you have ever thought about it, this whole argument about competing risks is nothing but a multivariate model argument. So I know it's a very morbid and a bad example to give, but I'll give you still read it. So, if you ever look at a death certificate of a patient, right, you'll see it'll say the patient has expired due to whatever, renal failure, myocardiac infraction or whatever. Typically there's a cause of death. The question is that the only cause of death? Or were there other risk factors which are also prevalent and worked in some sense, in a broader sense, in conjunction with that to cause a failure, but what has been recorded is only one of them? So think of it, a person, let's say there's a person who suffers from, let's just for argument's sake, let's say a patient suffers from hypertension, diabetes, renal problems, cardiac problems, put a few more, I don't really care. Now, the death certificate, and at some point the person expires. The death certificate does not list all of this, the death certificate lists only one of that. Now, is that the only cause, or were other factors also relevant? And therefore, if I were to model something around that, is it relevant to only look at that final factor? Or should I be looking at all of them and how all of them interacted with each other in the final outcome? The same thing comes out here, because after all, if you're looking at the market, if you're looking at financial market data, the question is, no information is independent of itself. So for example, one could argue it should not be the case, but what happens in the political space, what happens in the economic space and all of that do have a direct implication, direct or in some cases indirect implication in terms of the way prices in the market change. Right? Obviously supply demand impacts it, but other things also impact it. And therefore to say that I'm not going to model, I'm not going to look at these factors and I'm just going to look at how just the price change happens is not really going to get you a true value. And most of them are not going to be linear or simple correlation-based arguments, so we'd actually need something like a co-integration-based argument, which is essentially there is a relationship, but we are not assuming linearity. There's other challenges that also come in, which is essentially what comes in an event study model. And event studies over the years gained very significant prominence in this thing, because there are certain things which will happen, and it has implications around that. So again, just to give you an example to highlight the thing, okay, I'll use the actual information, not the data, but actually the kind of the thing. So in September 2001, when most of you were probably too young, or some of you may not have, assuming most of you, all of you were too young to realize, you had the Twin Tower disaster, right? The Twin Tower bombings and all that. Now, the Twin Towers collapsed on 11th of September, 9/11, right? At 7:30 in the morning, New York time. And there's a reason why I'm giving you the exact time. 7:30 in the morning or 8 o'clock in the morning, New York time was about 6 o'clock in the evening in India. And actually it was about 2 o'clock in Europe, and for the rest of the world it was well into the evening, not just in India. If you went further, Hong Kong, Tokyo, Tokyo was close to midnight, or actually past midnight, close to midnight. Hong Kong was Tokyo was past midnight, Hong Kong was close to midnight, and things like that. Obviously this had a huge effect in the financial markets, because there was a whole shaking up of the confidence that something like this could happen. People didn't know what was happening. Markets were expected to go all over, right? And therefore, if in normal conditions I had said, and if I say that, okay, on the 12th of September, when the markets opened, there was a huge drop in the market, right? All of you would turn around and say, so what's new you're telling me? This was expected. The amount of drop is something that can be debated, but the fact that the markets collapsed, the markets crashed, and there was uncertainty, high levels of volatility, what's new that you're talking about? Right? Now, if I tell you that it didn't happen, and it happened on the 17th, which was actually 9/11 was 11th, was a Tuesday, and this happened on 17th, which was the next Monday. How do you justify that? And that actually happened, by the way. It does, obviously in the normal scheme of things, it doesn't add up. 12th would easily add up. You could say, okay, even if you said the majority, there was a huge drop on 12th, 17th also something, another drop happened is fine, but actually in the markets what we saw was on 12th, the markets actually went up. The entire across the globe markets collapsed on the 17th. Now that's essentially an example of an event study argument. If I do not understand the event, I'll not be able to do this analysis. What happened, and just to give you the background and now to tell you what happened was, the moment it happened in the US, the entire global markets were frozen. Across the world, all global markets were shut down immediately. Majority of the markets were already shut, US shut down immediately. Through the night, people worked, and on next morning, when the markets were, because you can't have, because while you can shut down equity markets, you can't shut down currency markets, because then the entire financial system will collapse. So you still had to have financial transactions going through, you still had to have currency transactions going through. So what they decided was, through the night, that once they knew what was happening, and by the next hour or 2 hours, they knew what was happening, and that kind of brought it under, well, not under control, but at least the immediate aftermath was kind of contained. Across the globe, including the G20 and everybody politically, all the governments went in an overdrive and said, we will pump in huge amounts of money into the system to ensure the markets do not collapse tomorrow. Trading was restricted, very marginal, very thin trades were happening, and only the currency trades went through, and essentially the essential trades went through. But to avoid any kind of market collapse and panic in the market, the government stepped in. Across the world, the government stepped in and said, okay, we will pump up the markets. And that's exactly what they did on 12th, 13th and 14th for the next 3 days. 15th and 16th was the weekend, and by which time people had figured out what had happened and all of that. So over the weekend, the decision was taken again at the same level, saying that this, obviously you can't keep on supporting infinitely, you will have to pull out the support at some point. They decided that, okay, we cannot, this is the point, we're going to pull it out. And on 17th, the crash that we saw across the world was essentially a crash which should have happened on the 12th, but because of this support happened on the 17th. Now there are different arguments for that because the government support happened, the crash did not happen as much as it should have happened. There's alternate belief that no, you actually created a false sense and the crash actually happened more than that. That's a different discussion, a different debate to have, and we can keep on having it. But the point is now, if somebody were to look at market collapses and then say, I'm going to do an event study, market data would show that there's a huge drop on 17th. What's the rationale for that? So to do an event study, what we also need is essentially not just the impact, but also what has happened. Right? And why did it happen? Because otherwise, unless I understand the context in which, and this, by the way, I've just used this because this is a very well publicized scenario, but this kind of a thing has happened everywhere and keeps on happening all the time. And the argument in all of that is, if I do not know the context in which it has happened, event studies actually do not make any sense. But if I know the context and if I can understand the context, then essentially I can also use that as an application area to look at what has happened and what kind of a thing that happens. By the way, there's also while this is an advantage, there's also a downside to it. And the downside to it is, in the context of, so if you take a standard time series argument, and that's the problem that we still have in the co-integration argument. If you take a standard time series argument, and let's say you apply, there's a system in some level of stability, equilibrium, and you apply a shock, right? What should happen? The system will be, you will have a destabilized equation, right? Equilibrium will go away. Now if you let that system now run for some time, I don't know how long, but some time, the system will revert back to an equilibrium position. Right? Think of it. Take a pendulum. Right? This is the equilibrium position of the pendulum. I take a pendulum at this stage. I take it and I put it to this point, which means I've applied a shock and leave it from here. What will happen? It will swing wildly. And if I don't touch it any longer, at some point, I'm not defining what point. Obviously that depends on various other factors. But at some point, the pendulum will come and stabilize back at this point, right? Now, if the world was so simple, life would have been simple. The challenge that we have is, while this happens, now different shocks have different intensities. Actually, the same shock under different conditions could also have different intensities. Therefore, I cannot identify what is the time taken uniquely for the shock to get absorbed and the system, because why am I talking about that? The reason I'm talking about that is, you could argue that, okay, September 11 was an outlier. Such things cannot happen in the future. So why put it in our time series and historical data for future projections? Let me throw it out of the system. Standard outlier argument. Fine. But it is not just one day. The effect ran for 10 days. So I'm going to take, if I have enough data, so I can drop 10 days. Fine. But is 10 days the optimal time to drop every time? And that's the challenge. It is not 10 days. It could be 10 days here, it could be 5 days somewhere else, it could be 20 days somewhere else. Problem one. Problem two, which is the other practical problem. You have a drop. You have a shock. It has gone up. Now it's reducing. Right? Before it has come back to stable position, a new shock happens. Right? Which means it again goes up. So what I'm observing at that point, after the second shock, is a combination of residual impact from the first shock and impact from the second shock. And I have no means to identify how much of it was from the first shock and how much is from the second shock. So at any point, I can measure the impact. But how do I divide the impact into A, B, C, or whatever it is? And I cannot do that. Which means I can't even treat it as an outlier, because even if I drop it, yes, I may be dropping data, outlier data for something else, but in the process, I'm also I'm also terming some data as outlier, which may not actually be an outlier. Right? And the third thing, which is also relevant, is close to 18 years down the line, we can turn back and say September 11 is an outlier and it will not happen any longer. It's unlikely to happen, probability is very low and all that. In most cases, we're actually doing it reasonably close to the date. So if I was standing on 1st of January 2002, I do not think we had the ability to say that, okay, what has happened in September last year is unlikely to recur and therefore treat it as an outlier. So history allows us to do a lot of things, but again, that also has these challenges. So there are some other things that you can kind of do. So let me quickly show you a few. Okay, I had a few of them, but in the interest of time, let me just jump to one that I'm doing right now, we're working on right now. We can come back to the other ones in a bit, but let me just. So this is something that we are looking at it right now in terms of, in a very standard Indian context, and it's actually very topical for those of you who've tracked a little bit of it. One classic example of this is ILFS. There's a company called ILFS, Infrastructure Leasing and Financial Services Limited, which collapsed last year with a debt burden of about 93,000 crores. Okay. Don't even try putting the zeros. Even 1% of that would take care of most of us for our lives. The question is that, and the reason a lot of it fell through is because these are what are called as NBFCs. So, I just want to give you the context because, again, it's a contextual thing, but the approach and all is purely based on a quant time series approach. What we are saying is, typically there are two kinds of lenders in the market, the banks, but banks are highly regulated. And therefore, as a borrower, I don't always want to go to a bank because of the amount of regulation that I am subjected to. The simple reason as to why, this is in a much more sophisticated manner, but the simple argument on the other side is, as to even with the banking system where it is, why does village money lenders and local pawn shops exist? Because technically I can borrow from a bank. The reason why they exist is either you're unbankable and therefore they'll not lend you, or you want to circumvent the regulatory process. But the question is, circumventing the regulatory process for an individual may not really add much to the systemic risk. But when an organized setup gets into that, what is an implication in terms of the systemic risk that comes about? And this process where you're really acting as a lender, you're acting like a bank, but you're not a bank, is what is referred to as shadow banking. So shadow banking is actually, I'm doing things which a bank should have done, but I'm not kind of a bank. Right? I had a lot of it, but anyway, so a lot of it is the global crisis and all that, but let me just show you this. Some of the data that becomes relevant, and this is collected over, so as of last year, March last year, this is your gross NPA. So essentially, the banking system, the markets do not have access to being able to recover about 10,000 billion rupees, a little less. 9899. And at that level, that 100 billion doesn't really matter. I mean, so essentially we are saying that that's the amount of money that has been lent out in the system, which have not returned and have pretty much very low possibility of coming back. This includes obviously the Nirav Modis and the Vijay Malias and the SRs, and I can keep on giving you a whole list of it, but essentially this is where it is. Of which, out of this huge amount, about 9,700 was kind of directly to the banks. This is in the banking system. So about 98% of the gross NPA was actually to the banking sector itself, which is why we have a real challenge, right? And that kind of adds up to about 11%, which led the RBI to do what is called as PCA, prompt corrective action, which essentially initially highlighted 11 banks, brought it down later because of political pressure. So essentially, a bank is supposed to be in the business of borrowing and lending. Under PCA, a bank cannot lend. So essentially, the central bank is now coming in, and as a regulator comes in and says, you are so bad that you have absolutely zero ability to recover money, so you're not going to lend, you cannot lend, actually you should not operate, but because there's a problem, because there's other issues, actually some of these banks should not even operate, should not even survive. But if I shut down those banks, there are other social problems that will get created. Right? And therefore, you're basically just going to do basic banking, which is like, depositor. But that also has that from a banker's perspective is very problematic. Because after all, the profits for the bank or the money revenue for the bank is generated by lending. So if I cannot lend out and I am still forced to take deposits, it's actually a worse solution for me. But that's, and by the way, it's not just Indian banks. One of the world's oldest life insurance companies went bust pretty much because of a similar thing, which was Equitable Life. Equitable Life was a British company established in 1786 or something, and in the late 1980s, they had missold a huge amount of pension products in the market. And when the regulator figured it out, they figured out that if all the liabilities were to kind of accumulate and get realized, not just Equitable Life, even the British economy would not be able to, British government would not be able to sustain it. So what they did was they actually stopped Equitable Life from selling any further policies, which is a sheer shot way to killing a company, because unless you sell, so all they said is, you're not going to sell any policies. Because it's an insurance pension policy, unless there was like a catastrophe, all claims would not come in together. So you would have a staggered payout model, and hopefully that worked. And thankfully, over the last 20 years it has worked. So you will only service this policy till it kind of expires. And then you don't exist as a company any longer. They still exist technically because some policies are outstanding, but that's only a matter of time before which Equitable Life will no longer be there, even as an entity. So today it's kind of a shell entity only. So, one can look at some of this data, but the point out here is that this is the amount of exposure that exists, and what we wanted to check, and so what we also looked at is now, so where does the time series argument come in? I'm skipping some of the finance parts out here. So if you look at this is SCB's scheduled commercial banks. So how has the non-food credit for the commercial banks changed over a period of time from around June 2012 to February 2018? Over a 6-year span, how has the exposure, how has the credit that banks have given to non-agriculture, so non-food credit has changed, and you can see there is kind of a trend out there. Whereas in the last part, there's a drastic dip somewhere here, and then there is a rise somewhere out here. So essentially, is this modelable, and what does this imply going forward, right? And this is essentially, again, NBFCs are the shadow banks that we're talking about. SCB is a regular bank, so how is it going? And if you look at it, and is this a risk that we want to look at? The so-called unregulated NBFCs are growing much faster than where the regulated banks are. And as this gap widens, what does that imply for the markets? And based on, and where is these lines expected to go based on historical data is what we are kind of trying to look at. Today, I mean, again, when I say today, about a year back, when we collected the data, it was about 16% of the total lending. When the 16% becomes 32%, what is its implication? Right. Problem is fundamentally this, because they're not covered under RBI, but takes care of all the functions that a regular bank would do. So essentially the risk they're taking and the risk they're creating in the system is the same, but they are not governed or controlled. Nobody is there to control it, which essentially should create a joint exposure in the system. And interestingly, we have moved into a model where we are no longer looking at, the regulators are no longer looking at individual solvency. So the regulator doesn't care if an individual player is solvent or not. The regulator is actually, and which is correct, the regulator is more worried about whether the system is solvent or the system is stable or not. So an individual player becoming insolvent is not really a challenge because the cost of the systemic failure is much, much higher. An individual player going bust is not really too much of a challenge, and that's what it looks at. Anyway, so I'm just going to kind of show you what we want to look at. So what we wanted to look at is essentially historically looking at this. Does a joint exposure exist? If a joint exposure exists, okay, so, and again, who's sponsoring this AMCs? Because to circumvent the regulation, banks are also sponsoring it. So do the banks sponsored ones really doing things which the bank cannot do because of regulation and therefore using an alternate route to do it? And fundamentally, if there is an increased systemic risk, what's happening in the system? And how is the systemic risk increasing? So I'm going to cut the methodology out, but primarily, again, just to see what application of it, what we've used is essentially a very standard GMM technique, generalized method of moments, because obviously the usual arguments won't, the OLS and all won't work in estimation. We use what is known as a we use the Biperon test, 1998 test. The advantage of the Biperon test is that we know there are sequential breaks. We know that I can take as much. So if I go back, if I look at this data and even historical data, there are structural breaks, right? Nowhere is a structural break, and because the structural break, and there are different points that I need to identify. So the Biperon test allows me to identify L+1 sequential breaks, L+1 structural breaks in a sequential manner. That's why we kind of use that sequentially determined break model. Obviously, one can look at more details out there. Then there are rationale as to why we kind of look at it, because the composition when cash holdings change over a period of time. So it's not that a bank has the same composition of cash and non-cash holding over the entire horizon. And as the base changes, your model, your structural equation also should change. Because today I may be like holding 90% cash and only 10% assets. Over a period of time, I have lent out most of the assets, most of cash, and added assets. My value might still be the same, but the composition has changed. And with the change in the composition, the risk has also changed. Because realize if I hold cash, risk of default is very low. I'm holding cash, right? But return is very low. On the other hand, if I've made investments in other assets, which are assets that I have, my return may be very high. But now my ability to repay my account holder is dependent on you paying me, and therefore the risk profile completely changes. Right? And also that's the market driver. Then there are obviously regulatory factors which could kind of change that. The reason I wanted to show you this is because basically I wanted to highlight these three papers. There are these papers by Diebold and Neelima, 9, 12, 14. This is again a more recent development as compared to co-integration. So again, you can kind of look at interlinkages, non-linear dependencies, non-linear interlinkages, to look at how does the two work together and what's kind of happening in that process. Okay. The connectedness and all that. Data, we don't have to really bother about it, but what it shows is data is not a problem. Historical data is not a problem. You have enough sources to get historical data. The good thing is data and a historical data set is not a challenge. You will easily get it. You may have to work around because there is a problem of the way the data comes in, because and that's the very standard issue. Each provider records data in a unique manner. And therefore, to kind of match the set to have a composite database is quite a bit of a challenge. You have all of it, so it's kind of a lot of work or fair amount of work to say, okay, now I create a composite data set which has all the information mapped together. So you'll see RBI will give you some data weekly, monthly, annually. Somebody else will give you, semi-annually. So you'll have to work around that to kind of match it to get that. But it is doable. Data is available, it's doable. Okay, so we did some preliminary results, since I've shown you all of that. What we find is that there is an exposure. Interestingly and not surprisingly, HDFC has, we looked at the three main players in the market. HDFC has the highest exposure to its subsidiaries, followed by Axis, ICICI and Axis. Exposure is higher to private banks as compared to public sector banks. Again, with somewhat unexpected lines, and the exact details are there in the table, but essentially just to cut the long story short, these exist and you have these challenges, you have these things that are there. This is from, we looked at exposure from AMCs, so the NBFC, asset management companies to the banks. What about the NBFC, which is the shadow banks to the banks? Well, in all the cases, you see the answer to what we want is essentially the yes. The parent bank sponsored AMCs have exposure to the parent bank based on all these historical data analysis that we kind of look at. Parent bank sponsored AMCs, yes. AMC to exposure to other bank sponsored NBFCs, yes. And within the banks, exposure to individual banks and NBFCs within limits, obviously, the answer is yes. So essentially, there is a huge amount of exposure that gets created within the system. Do they undertake liquidity transformation? And how did I get those 4 periods? This is where the biperon test comes in. So the biperon test automatically identifies for me what are the structural break periods in that. So it identifies in this data set where the period that we had from Jan 12 to Jan 18. It identifies this 4 as the 4 periods, and in each of the cases it tells me whether there was a liquidity transformation, essentially shadow banking activity on different heads happening. The most interesting results that came out were this, which essentially, again, there are a lot of graphs out there to show you, but anyway, I'll just quickly identify what I'm trying to talk about is essentially saying that there's a huge amount of interdependence between, each colored graph, for example, in the first one up there, the red is public banks, blue is private sector, and the yellow is the housing finance companies because there's a huge amount of exposure. And you look at the interdependence and the way they are moving together, particularly the private and the public banks. So there's a lot more that's happening out there. These are obviously initial results and all that, but we've been looking at it. But a lot of that, there's an interlinkage that's happening. There are trends that are coming out, which needs to be analyzed. Some of that has been done specifically with respect to 1 or 2 companies, but the primary companies. But again, a lot of it can be essentially looked at. Spillover between bank and NBFC can also, and all of these cases can be kind of looked at. What the good thing is that over the last year and a half, this has reduced a little bit. The question is this stable? I think one needs to now test for the fact, is this stable, or is there some level of instability, and one has to kind of look beyond that. So initial just to kind of give you some initial findings on this is what we have. Yes, there are joint exposures, but thankfully, as of now, the exposures seem to be within the limits. There is liquidity transformation that's going on. There's no question about that. The spillover effect is there. That is, what does the spillover effect mean? I should actually talk about it earlier, that what is happening in one market impacts the other market. So if the 2 markets are independent of each other, life is simple. So what happens out here does not impact on the other side, so it's contained. But what's happening out here with the spillover thing showing is that something that happens in market A also impacts market B and has an issue with that. That's what we are kind of also finding in the whole process. So, I had a few more things that we had worked on in the past. The presentation is there, you guys can have a look at it, which basically uses all standard techniques. I just wanted to highlight this because it's something which is pretty interesting and pretty new that we are looking at, and using fairly recent techniques that have been talked about. potentially highly topical, because if these results hold in a slightly larger context, this potentially has huge policy implications. With this level, if the level of interdependence that we are seeing actually holds true, then for a policy formulator, for an RBI or anybody, you better be careful, because you better kind of create Chinese walls or whatever to ensure that dependencies are reduced, or you bring things under control by using other regulatory measures. So because the challenge is, if one market, if we don't do it, and if this is prevalent in a widespread basis, the risk is a failure in one market will completely impact and eradicate the other markets. So it's not just a failure in the equity market, a crash in the equity market could potentially impact entire investments in the housing finance, in bond markets and everything else. So you would actually see a risk on the entire financial system. What we are seeing at this point is a huge increase in the risk in the financial system. Not about a single player, not about a single sector, but about the entire thing. And therefore, there's a regulatory implication that typically has to be accounted for. So that's an application that can be looked at in that sense. Okay, I'll just end with this last point, which I think is interesting. And there are some people who are working on it. I also kind of tentatively believe that this is possible, and we should be looking at that, which is predominantly that traditionally people have either done based on time series approaches or done on stochastic model approaches. What if we and there are few people who've started looking at it, what if we interlink both of them? Again, incidentally, the idea does not stem from finance. The idea actually stems from a long back, again, I think a 1950s work by Cox, in terms of talking about doubly stochastic Poisson processes. And the logic is, to explain the logic is something like this. Let's say an earthquake happens, right? I proxy the intensity of the earthquake to equate out to the losses suffered in a certain region, in a region. Because the standard argument is, the more stronger the earthquake is, the disaster, and therefore the losses will be higher. So I'm using this as a proxy for the disaster, right? So now let's say an earthquake happens today, or has happened today, which means I know the current intensity and the time at which the earthquake has happened. Now, do I know when the next earthquake will happen? And when the next earthquake happens, do I know what the intensity would be? Right. Because if an earthquake happens today, you can have an earthquake again tomorrow, or you may not have an earthquake for the next 10 years. So there is kind of a random process on the x-axis, in some sense, if I would talk about the x-plane, x-axis, and for the same intensity, or for, I don't know what the intensity would be, again for the same intensity, the damages at different points could be different, or for a lower intensity it could be higher, and whatever else. So again, that is random. So essentially, we have two random processes working in tandem, and I'm sure one can extend this to more than two random processes working in tandem, and in between, I could actually have some kind of historical data-based approach to talk about it. And that's what I mean by saying intertwining with stochastic models. So it's not essentially that you're looking at one completely independent of the other. That's been the traditional approach, and I guess initially one would have to do that to understand what is going on. But at some point we're looking at, can we kind of come to, I'm not saying merge the two together, but look at both of them simultaneously, so that there is certain amount of time series benefits that exist, and there is certain amount of randomness that also exists, and can we kind of look at that. The rest are very standard stuff that I had. I already talked about long memory earlier. Long memory is also very important, because the classic example of long memory, to really stop with that, is all of us today know that in 2007, 2008, we had what is known as the global financial crisis. Right? When was the last time prior to that a financial crisis had happened? 1929. 1929 to 1936, the Great Depression. Exactly 75 years later is when we had the crisis again, right? And looking back, people have said a lot of the things that happened in 2007, 2008 crisis were an outcome of what was similar to what had happened in this 29 to 36 period. And post the crisis in 36, there was huge amount of regulatory burden that was put on, which over the years was relaxed. And there is a school which believes that the 2007 crisis build-up was essentially because a lot of these relaxations had happened and taken for a ride. Now, how much of a history do you take? So in a sense, the whole argument of long memory is, if you looked at 90s data, 80s data, early 2000 data, 2007 was nowhere in the horizon. No model anybody could predict. I know, and I am a big fan of his, Rangarajan in a paper in 2005 has predicted 2007. I mean, I'm sure there are hundreds of people who've done it. Right? We also predict a lot of things. And if it matches, fantastic. If it doesn't, then it's like one more paper written somewhere, who cares? Honestly. Because none of the data could actually predict that 2007 would happen, based on that amount of data. Now, am I going to go back to 1929? Postmortem analysis has shown that if you went back, you had a higher predictability. You still couldn't predict 100%, but a higher predictability. Right? So again, how much is a long memory? And there is a long memory implication that happens. So that's something which is pretty interesting and important, that we kind of keep on looking at it. Okay, let me stop with this. Any comments, questions? Or people are too eager to run out of here? Yeah.
There is policy here. By definition, shadow banking can't be regulated.
By definition, shadow banking can't be
regulated. So how will you design the policy?
Well, I'll make sure. I mean, okay. Two answers. I'm not RBI. I'm not the finance minister. You have a new finance minister today, Nirmala Sitharaman. So, and both of them are not paying me to give them advice. Anyway, but I think what one can do is, essentially, I should make shadow banking redundant. I don't regulate shadow banking, but I just make shadow banking redundant. I design a policy on the other side so that shadow banking becomes redundant. I mean, that's the easiest answer to it. How easily it is doable, what can be done, is what has to be looked at. And it's been done, by the way. I mean, not in shadow banking. Just to give you a parallel example, it has been done and in the classic case, it has been done in GST. So if you think of GST, again, without getting into all of the details, what GST does is gives you input credit. So any tax you pay on the input side, you get an input credit, so therefore you don't have to pay taxes on the other side. So that's a credit pass-through. What it has also done is, unless the supplier from whom you take is GST registered, you don't get the input credit. So you'll have to pay GST. Now you may have paid GST to somebody, but I mean you have paid tax to somebody, but unless that guy has a GST credit, GST registration, you don't get the input credit. What does this mean? That means that essentially anybody outside the system will no longer be able to do business, big time business. So you've created the environment in the other way by saying everybody needs to be in the fold for the benefit to come in. So there is examples where you have made the alternate redundant and therefore everybody has come this side. Okay, thanks. Anyway, Professor Apte has the presentation, so whatever I didn't use, no, he's already copied it on the pen drive. So, you have it.